2.5 weeks ago, the headline hit, most hated market rally ever. And now the market's done nothing but go up since. Are we at the top? Finally? What's even driving this? Do these narratives make sense? What on earth is going on? When will we get the correction? When will the pieces start to align? Let's talk about it. You know, one of the craziest things about this market is usually when you see a market push to these levels or something really unexpected to happen, you'll see one of these names on Twitter or YouTube or somewhere say, look, I told you this was going to happen. I am the king of the world. I'm a genius. And there's no one doing that, which actually shows you how irrational this market really is. No one really expected the market to actually push to these levels, and these narratives that have kind of gripped it to really propel us to what is becoming ridiculous highs. The daily RSI in the market is over 70 now, clearly overbought. And now people are like, well, I guess it'll just go forever. But to me, that's the signal that retail has been baited. And I think that what we saw on Friday with that big push was retail once again buying the top. But does that mean that they're actually done? We could see where the 200-day moving average is on this Bloomberg graph of the purple line right here. We can also see where this trend line is also developing. Looks like there's going to be a crossover here, and that could be the market top. This would also push it closer into those Fibonacci ranges that we saw earlier. But that can't be the only thing we look at. As we can see here, the S&P index melted up pretty hard on Friday, but we started to see VIX also start to catch a bid. If you follow me, I took this as an opportunity to buy volatility, and we're starting to see it melt up with the market, which is usually not a good sign for the index. So we'll talk about where the future of the market could go, but first, let's tune into some economic data. Okay, be honest with me here. When's the last time you actually planned out your spending, your finances, or planned for your retirement, or how to preserve the wealth you already have? Listen, you need to call Rob Reed. There's no one better. Learn about different investment strategies to help you create or preserve your wealth. It's for your success. You know you need to get it done. I know you've been pushing it off. But honestly, learning about index-based life insurance, which is basically like a rich man's Roth IRA and allows me to be my own bank, was huge. So if you want to learn more, call the number above or visit cwrpcg.com. Wednesday is going to be the big day here. We have the FOMC minutes coming up, and the big narrative is that the Fed will be able to pause on their interest rate hikes since inflation has become stagnant. Now, inflation's still at 8.5%, and they told us we would need to see multiple prints with inflation coming down or at their target levels before they would stop the hikes. However, lots of people and even big names are saying that this market could take a pause and that inflation will start to come down on its own. So let's take a moment to dive into the different narratives for this current market environment. And for that, I'm actually going to turn over to a Substack by Alf, who is a former $1 billion hedge fund manager. He's also written one of the educational sources in the Discord for bonds. And as we can see from this article, this is the end of the article. In short, the soft landing narrative seems misplaced. A soft landing implies a marked slowdown in inflation while growth remains robust. So the goal of the Fed is to crush inflation, but not actually crush the economy. They don't want a recession, hence why they changed the definition. While the direction of travel seems right, lower inflation, growth cooling towards trend. And so we haven't seen much destruction in growth, but inflation is making a market, is kind of coming down, becoming more stagnant. The evidence towards a rather steep drop in economic activity and not a measured and controlled slowdown consistent with the Goldilocks narrative. So the steep drop in economic activity is not what we want, but that seems to be where the economy is headed. The Goldilocks narrative, just for reference, is when the market's in a Goldilocks phase, that tends to mean that, okay, now it's time to buy high growth names, get really leveraged in this market, go long because it's going to go straight up, which it seems like that's what the market's trying to do, but he doesn't think it's time to do that. Neither do I. Grim forward-looking economic indicators, such as negative real wage growth for 1.5 years. That means for the next 1.5 years, he's expecting negative wage growth. And remember, wages have been going up pretty handedly. And a reach for the credit card debt to bridge the purchasing power gap. So what he's saying here is that he thinks that as inflation's gone up, people have wanted the same goods and services, but they're more expensive and they can't fit them in their budget. So people might start reaching for the credit cards, start loading up more debt so that they can afford the same lifestyles. That is not good at all, because that creates a credit impulse wave in the market that is not sustainable. Multiple job holders accounting for the job creation. I love how he's put that in quotations, since March. Remember, we've talked a lot about the jobs numbers as well. This is showing that people are having to get multiple jobs, not that they're just employed, which, everyone getting employed would mean a very effective and efficient economy. Everyone having to get multiple jobs just to live and survive the lifestyles that they have the lifestyles that they want to have is not a good sign. And our G5 credit impulse metric all suggests that this is not going to be a soft landing. And as you can see here by the graph that he's produced, we can see that the expectation is that CPI continues to go down into the end of the year, but that growth will also come down heavily into the end of the year. But Alf's position isn't the consensus as well. There's still a good camp of people who think that inflation could be persistently high, and it wouldn't be that surprising to see when you think about the factors that are coming up in the market and the things around the corner. Remember, food prices were still rising, as Alf mentioned, and lots of people think that the services and the stickiness there will also be consistently high. Jim Bianco's been a huge advocate for this. He's another person who runs a research, and I often read through his articles as well. One of the things he brought up when he was been asked the question, well, the Fed will pause, just look at this Bloomberg data is what he says. And it's hard, when you look at this is the consumer price index with core inflation. Look how high this really is on this graph here. Could you really see the Fed wanting to pause with the data looking like this? Becomes harder and harder to really piece that together and think that that is the position they'll take. However, we're just going to need to wait until Wednesday to see how that plays out. Although I think everyone is starting to agree that growth is going to be a major issue heading to the end of this year and the next. Now, that's a lot of the narratives surrounding the market. Let's go ahead and talk about the more mechanical side of what's actually occurring in the market. And that is a little bit of a different story. If we head into the Discord and we go ahead to some of the charts and data, remember, if you're a subscriber to the Discord, you have access to all of this. We could see that the positioning in the market is really light. And if we go back over to that graph that I shared as well, where we're looking at the S&P, and I'm saying, hey, this looks like a third wave followed by a pullback. Let me move myself out of the way. This looks like a third wave, which means we could see a pullback, and then a fifth wave with even higher highs. It's kind of hard to kind of think about how that would pull around or play out. But when we look at this data and we see that, hey, the market's extremely light right now, we could see a lot of people say, man, I don't want to miss this rally. A lot of these hedge fund managers, they need to make their clients money. They need to get in the market. And we can see how lightly positioned they are. This is how Goldman Sachs and a lot of investment banks and hedge fund managers are positioned in this market. They're likely want to get in the market before the elections because there's such a huge historical precedent for that being a great time to get into the market. So although I think that the rest of this month and September could be rough, it still could be a great time to get in that market and get in that final rally. And it wouldn't be hard to see that a lot of people aren't even in this rally and are going to want to be in the next one around the corner. This is further driven by this. Look, there's no risk appetite in this market either. So the market's still rallying up, but where is everyone in this market? They're not there. They're not participating, meaning there's still tons of money on the sidelines. And I wouldn't be surprised to see it want to chase another rally. So what does that actually mean for this market? Well, it means that the macroeconomic consensus is a mess, and I don't expect it to improve, which means that on the next dip, it's time to go back to some stock picking and technical analysis, in my opinion. Because remember, we didn't even talk about the geopolitical factors in this episode. We didn't talk about the embargo on Taiwan or what's going on with U.S. diplomats, the raids against Trump from the FBI, who in the past has falsified warrants to do stuff like this before. Even the DOJ came out and admitted that. So, there's a lot of distrust with American institutions, a lot of distrust with geopolitical leaders and what's going on in the globe and what's causing people to do what. There's lots of hunger that's going to be coming around the corner as well because of the Russian-Ukraine incident. The energy crisis is still ongoing, and I'm just now at a point where I want to go long on the next dip for some growth names that I really like. Hope to catch that fifth wave rally into the end of the year. And just to interrupt myself, but not to brag, but we've been crushing it when it comes to the stock portfolio. When it comes to stock management, I want to be absolutely blowing most managers out of the water by the end of the year. And it looks like we're already on the path for that. Just wanted to chip in and throw that out there. Join the Discord so that you can keep up with my portfolio as well. And then also be hyper aware of everything going on in the macro front, because I do think that we're starting to reach an environment that'll be very afraid of a crash, which we've been in, which I've been saying and iterating that I'm still very scared of this market, about how this could play out. I'm worried about a deep recession that could come around, although right now, based on everything we're seeing, based on all the evidence, lots of cash on the sidelines, it's going to want to chase this final wave. You'd be a fool to not want to get into that. So remember, join the Discord to get all the info. If you want all this in real time so you can keep up, you want all the charts and all the other data that we didn't even iterate in this video. This is just a tad bit of all the information that's really getting passed through in the Discord and the conversations being had and the educational content that you can receive. Ask your questions in there so that you can stay informed. More than happy to provide. Hope you enjoyed this edition of the Sunday Report. And just so you know, we're going to be pumping out a lot of content this upcoming week because there's a lot of things to talk about that didn't make it in this video. So make sure you subscribe, like the video, show some love. I really appreciate it. Ring that bell, because even though the market's closed, we don't. And I'll see you very, very soon and next week for another report.